As a year comes to an end, most businesses ask one of two questions. How can I make more money? Or how can I stop giving so much away in taxes, right? Today, we're going to talk about a move that does both, especially if you rented equipment this year. Most businesses think, or business owners think, the only way to reduce taxes at the year end is to spend cash. That's wrong. Some of the biggest tax write-offs don't come from writing a check, but it comes from how equipment is structured and not how it's paid for. Now, I see this consistently with contractors and business owners. You rented equipment all year, trucks, lifts, machines, tools, and at the end of the year, you spent tens of thousands and you're asking, how do I reduce my tax bill? The answer might be sitting right in front of you, buying or financing equipment that you already use. Now, here's the biggest myth that I hear. You can only write off equipment if you pay cash, and that's not true. For tax purposes, ownership matters more than payment. And if the IRS considers you the owner, you may be able to deduct the equipment even if you financed it. So let's break it down simply. If you buy equipment with cash and place it in service before year's end, you may qualify for Section 179, bonus depreciation, or standard depreciation. It's simple, but it ties up cash. Now, financing with a loan, this surprises people. So if you finance equipment with a loan, you may still deduct the entire purchase price, even though you're paying it monthly. Now, why? Because for tax purposes, you own the asset, and it's one of the smartest year-end moves when cash flow matters. And let's talk about the the different leases because not all leases are the same. So you got the operating lease, which is more of a rent style type of lease. So think of it like renting. If you don't own the equipment, you can't depreciate it, and you can't use Section 179, but you can deduct only the payments made during the year. Now, that's good for flexibility, but not for large end write-offs. Now, capital or finance lease, and that's the one that matters for taxes. A capital lease, sometimes called a finance lease or a dollar buyout lease, is treated like ownership for tax purposes. If structured correctly, the equipment is considered your asset. And you may qualify again for that Section 179, the bonus depreciation, or regular depreciation. And this is the type of lease that allows major tax planning before December 31st. Now, there's one rule that people miss, and this is really important. The equipment must be placed in service before year end, and that means delivered, installed, and ready to use, not just ordered, not just approved, not just invoice, because you miss this and your write-off moves to next year. And isn't about buying equipment you don't need. It's about being intentional with the money that you're already spending. Now, if you rent an equipment this year and you plan to buy anyway, the structure and timing could change your tax outcome dramatically, especially before December 31st. Ask, can I afford it? But how can I structure it? Because you're going to save money anyway since you've been renting that piece of equipment. If you have questions or figuring out how to structure it, definitely reach out to us.